China's state-backed chipmaker just proved it can manufacture 7-nanometer chips at commercial scale. According to independent engineering teardowns from TechInsights and SemiAnalysis, SMIC achieved production maturity on 7 nanometers in late 2023 through early 2024, the same capability where TSMC was in 2020. That's a 3-year compression under comprehensive export controls designed to prevent exactly this. Here's the real story. It's not about SMIC catching TSMC. It's about the demand that TSMC lost from China already going to SMIC. This is Wafer Street. Here's what moved and what it means for your money. Let's start with what actually happened, because the headlines are missing the supply chain math. SMIC, Semiconductor Manufacturing International Corporation, China's largest foundry, achieved 7-nanometer production at commercial scale. The proof is in real chips now shipping. TechInsights documented SMIC 7-nanometer production in multiple commercial products. There was a Bitcoin miner in July 2022, which was early test silicon. Then came the Huawei Mate 60 Pro processor in September 2023, marking the commercial debut. More recently, analysis of the Kirin 9030 revealed SMIC is already pushing toward 5-nanometer capability. SemiAnalysis confirmed the same independently. SMIC has been shipping 7-nanometer foundry ASICs as of July 2022, with ongoing verification of production scaling. Here's what matters. Official SMIC statements remain opaque, but third-party engineering analysis, the industry standard for verification when companies don't disclose, shows yields competitive with where TSMC was in 2020. That's a 3-year gap, compressed in 4 years, under an export control regime that was supposed to prevent exactly this. That's not a coincidence. That's strategy, and it's working faster than policy anticipated. If you're following this kind of analysis, hit subscribe. New episodes drop every Wednesday. This is where we break down supply chain moves that most coverage misses. The 3-year gap is the story, not absolute capability. What matters is speed. TSMC entered 7-nanometer volume production in Q2 2018, launched N7+, with first commercial EUV in October 2019, and by mid-2020 had shipped over 1 billion 7-nanometer chips. That's mass production maturity achieved in roughly 2 years from volume start. SMIC achieved commercial-scale 7-nanometer production in late 2023 to early 2024, with test silicon in 2021 and 2022, then commercial debut with real products shipping. From TSMC's 1 billion chips milestone to SMIC's commercial debut, 3.5 years. That's unprecedented acceleration, achieved while operating under comprehensive export controls implemented in October 2022. Those controls specifically banned advanced semiconductor manufacturing equipment exports to China. Here's the choke point that actually decides who wins. It's not the machine or the chip, it's the timeline. Whoever can compress development cycles fastest while operating under sanctions gets to define the next phase. China just proved they can. Here's where this turns into a supply chain story, and where most coverage gets it wrong. China's share of TSMC's revenue dropped from 20% in 2019 to 9% in 2024. That's an 11 percentage point decline. On TSMC's $75 to $80 billion annual revenue base, that's roughly $8 to $9 billion in lost China customer demand annually. That demand didn't disappear, it went domestic. Watch what happened to SMIC in the exact same time frame. 2019, $3.12 billion in annual revenue. 2020, $3.9 billion, plus 25% year over year. 2021, $5.44 billion, plus 39%. Peak growth during the chip shortage. 2022, $7.27 billion, continuing expansion. 2023, $6.32 billion, inventory correction. 2024, $8.02 billion, plus 27% recovery. 2025, $9.33 billion, plus 16% continued growth. Total, 199% growth from 2019 to 2025. The timing is not coincidental, it's substitution. As TSMC's China revenue contracted, SMIC's revenue exploded, with inflection points aligning and growth trajectories mirroring each other. Here's the critical insight nobody's talking about. SMIC's growth is strategic, not random. It's targeting exactly the segments China was importing from TSMC. Follow the money and the story changes. An export control regime designed to keep China dependent on foreign foundries just got proof that the dependency has an expiration date, and that expiration date was 2024. Now let's talk about what most analysts miss: capacity. Chinese foundries' global market share looks modest on paper. They went from 7.5% in 2019 to 9.1% in 2024. SMIC went from 4.5% to 5.8% to 6.0%. Sounds incremental, right? It's not. The real story is physical wafer production capacity, not market share percentage. Chinese foundries now control 33% of global wafer production capacity for foundational and mature node chips, the 28 nanometer and above process nodes. Those nodes used to come almost entirely from TSMC. SMIC's capacity is estimated at roughly 20,000 wafers per month across its 7 nanometer production. Industry analysis suggests Huawei is absorbing roughly 75% of that capacity. That's about 15,000 wafers monthly for Kirin mobile processors and Ascend AI accelerators. The rest goes to other Chinese hyperscalers and spot market orders. Here's the choke point. SMIC isn't trying to compete with TSMC's 150,000 plus wafer per month global capacity. SMIC's capacity is sized precisely to absorb the demand China was importing from TSMC. That's 20,000 wafers per month, replacing what used to come from a foreign supplier. This isn't competition. This is substitution, and it's happening at scale. The capacity numbers and financial data tell one story, but the real proof is in what China's largest hyperscalers are actually announcing right now. Alibaba announced in May 2026 that its proprietary T-head AI chips, specifically the Zhenwu M890 and Zhenwu M810E processors, have achieved production at scale. Where? At domestic Chinese foundries. The company's exact words. At the infrastructure layer, our proprietary T-head AI chips have achieved production at scale, delivering high-performance compute capacity to our cloud infrastructure and model-as-a-service inference platform. That's a major Chinese tech company publicly transitioning core infrastructure away from foreign foundries. ByteDance is pursuing a parallel strategy. The company is actively sourcing domestic Chinese accelerators, specifically Baidu's Kunlunxin and third-party domestic alternatives, while simultaneously designing custom CPUs targeted for mass production in the second half of 2027. Tencent took a different path, but reached the same destination. In September 2025, the company publicly announced it has fully adapted its cloud infrastructure to run entirely on homegrown Chinese processors from multiple domestic chip designers. No proprietary designs, but complete commitment to domestic silicon. The capital commitment, 79 billion yuan, roughly $11.5 billion, specifically allocated to domestic computing infrastructure build-out. Here's the money fact. Tencent announced this $11.5 billion capex allocation and then increased it further in March 2026 as earnings accelerated. This isn't a pilot program. This is a multi-year infrastructure transformation. This isn't theoretical. This isn't planned. This is happening right now. The demand that TSMC lost from China isn't sitting on the sidelines. It's being actively redirected to Chinese foundries that are being built, scaled, and filled with orders from the country's largest hyperscalers. SMIC's 7 nanometer breakthrough is the inflection point where that shift becomes irreversible. Here's where this moves from market dynamics to policy, and it's the part that explains why the timeline compressed faster than anyone expected. China's fab expansion wasn't organic. It was deliberate, state-backed industrial policy spanning decades. The National Integrated Circuit Industry Investment Fund, known as the Big Fund, is structured in 3 phases. Phase 1, 2014 to 2019, $21.8 billion allocated to baseline IC industry development before major export controls. Phase 2, 2019 to 2024, $29.1 billion. Notice the timing. This phase began immediately following the first Huawei export restrictions in May 2019. That's not coincidence. China accelerated state funding in direct response to US policy pressure. Phase 3, 2024 to 2039, $47.5 billion. The largest phase, deployed after the comprehensive October 2022 export controls. This is the big one. A decades-long commitment totaling more than Phase 1 and Phase 2 combined. Total Big Fund investment, $98.4 billion. Combined with local government guidance funds from Shanghai, Beijing, Tianjin, and other cities, plus state policy bank credit from the China Development Bank, and direct R&D and production subsidies, total state-backed semiconductor spending exceeds $142 billion between 2014 and 2023, with projections above $150 billion through 2039. Timeline alignment, 2019, export controls trigger. Phase 2, funding accelerates. 2022, comprehensive restrictions implemented. Phase 3, preparation begins. 2024, Phase 3 launches with its largest allocation. SMIC 7 nanometers achieves commercial scale that same year. This is not coincidence, it is strategy. Export controls didn't stop China's semiconductor ambitions, they accelerated them. They forced China to build domestic alternatives, and now China is deploying plus $150 billion over decades to complete that transition. Phase 3 proves the commitment isn't 1 year, it's 30 years. That's the choke point that actually decides who wins. It's not the machine or the technology or the single year's performance. It's the commitment. Whoever can sustain a decades-long capital deployment strategy gets to rewrite the supply chain. For policy operators, this is evidence that node-specific export restrictions have a shelf life. Once China proves it can build advanced nodes domestically, the leverage you were trying to preserve just evaporated. The real policy question now is the timeline until other nodes follow 7 nanometers path. Watch SMIC's yield progress quarterly. Each percentage point of improvement accelerates the timeline for 5 nanometers and below. For retail investors, don't read SMIC achieved 7 nanometers as SMIC is now equal to TSMC. Read it as TSMCs. China revenue just got a permanent competitor with rising yields and zero export control risk. Watch TSMC's China revenue guidance for evidence of migration. If China-specific revenue stays flat or declines, while SMIC volumes rise and SMIC's capex accelerates, that's your signal the substitution is real and accelerating. TSMC's valuation assumes China revenue stays stable or grows. If it doesn't, the market will reprice that exposure. For tech and AI operators, this is the clearest sign yet that Chinese AI infrastructure is becoming structurally independent of Taiwan for mature and mid-range nodes. If your roadmap assumes you can always source from TSMC at any price point, this quarter is telling you to reconsider. Plan for a bifurcated supply chain where Chinese companies gradually shift critical workloads to domestic foundries. That happens faster than Western policy anticipated. If you're already in China's ecosystem, this acceleration is accelerating. If you're outside it, watch the timeline. The substitution is visible in real time. Before you go, here are 3 numbers to keep in your back pocket from this one. First number, 7 nanometers. That's the node where China just proved it can operate at commercial scale, not leading edge, good enough for the majority of workloads that don't require the absolute highest margin chips. Second number, $9.33 billion. That's SMIC's revenue in 2025, up 16% year over year. Compare that to $3.12 billion in 2019. That's 199% growth. That growth correlates perfectly with TSMC's China revenue decline. Follow the money, and you see the substitution. Third number, plus $150 billion. That's the total state-backed semiconductor investment China is deploying through 2039, structured in decades-long phases that prove this isn't reactive. It's strategic. That's not a one-year bet. That's a national commitment to semiconductor independence. Here's the question I'm sitting with, and I want to know what you think. Is China's domestic chip capability already good enough to sustain complete independence from foreign foundries, or does SMIC still need years of yield improvement to truly replace TSMC for mission-critical workloads? Drop your read in the comments. This is the conversation we should be having. Here's my read. This isn't a story about the US losing the chip war. It's a story about both sides discovering that absolute supply chain dominance is harder to maintain than it looks on paper. Washington can restrict exports. Beijing can build alternatives. Both sides can scale. And the whole time, the actual supply chain is being restructured right in front of policy faster than policy can adapt. But here's what matters going forward. Export controls don't stop capability, they redirect it. And once it's redirected domestically, the foreign supplier becomes optional, not essential. China just proved that. SMIC 7 nanometers is the inflection point where that optionality becomes permanent. That's the real trade to track. If this analysis landed, like and share it with someone else tracking the supply chain. The more people understanding where the real leverage sits, the better the conversation gets. Follow the money, follow the channel. See you next time.